Welcome to this video on the acquisition method, a very critical component of CFA Level 2 financial statements analysis. Lots of questions within your curriculum, your mock exams approach this from different angles. You have to appreciate the difference between how we compute goodwill under the full method, the partial method. This also has an impact on the amount of non-controlling interest a company shows in its balance sheet post an acquisition. So absolutely critical topics here. We'll discuss this via questions, warm-up questions, and then sort of more proper ones. If this is your first encounter with the Let Me Explain YouTube channel, then a warm welcome. Please consider subscribing or even becoming a supporting member to enjoy all the videos that are on the channel. Okay, let's get cracking. We're going to dive straight in to questions. We're talking about a situation where there is a controlling stake being acquired in a different company. So let's read on the left-hand side. On the 1st of January 2025, investor acquired a controlling stake in the share capital of Target. The fair value of Target's shares on that date was 20 million. At least initially, that will not be terribly important, at least that second sentence. Immediately before the transaction, the two companies compiled the following information, and we've got balance sheet data for investor, the target. You can see different items of assets and liabilities, net assets, equity. Now, this equity 37 and 23 gives 60, which is exactly equal to assets minus liabilities, and same thing happens here. That's 9, which is equal to the 9 up there. Now, for the target, we also have, or we are provided with, some fair values for their assets and liabilities, at least the ones that are identified. We'll talk a little bit more about identifying assets and liabilities in the subsequent video, the next one, but please note that there is an important difference here with respect to property, plant and equipment. Its fair value is deemed to be higher than what the target company shows in its books, and that's absolutely normal. During an acquisition, you're bound to find assets that are worth more than what's being shown in that acquired company's balance sheet, or indeed identify assets which are not at all shown in their balance sheet, and that primarily pertains to intangible assets like brands, trademarks, that kind of thing. More on that in the next video. The remaining assets have the same book values and that liability as well. Now, a warm-up question is question 1. If investor acquired 100% of the share capital of Target for 20 million, which is sort of we are told before, it is the fair value of Target's shares, 20 million, yeah? If they paid that fair price, and they paid it in cash, the value of goodwill recognized in respect of the acquisition is closest to. Now, this really is a level 1 recap, because at level 1, you were supposed to appreciate what goodwill is, and at least kind of know how it is computed. So maybe you watched some videos on this, maybe you did some questions on this, maybe you didn't. It doesn't matter. When the acquisition is for 100% of the shares of another business, so you're basically taking it over, what will happen is you'll contrast the purchase price, that's 20 million over here, obviously taking this from over here, with, in terms of contrasting, so you'll deduct the fair value, the FV of those identifiable net assets of the acquired company of the target, and that means looking at the third column over here and noting that net assets, when expressed at fair value, are equal to 15. So that's the difference between the total of the assets and the total of the liabilities. And that is, of course, higher by 6 than the book value of the net assets, or the book value of equity of the target. And that's due to that first asset, the property, plant and equipment, being worth more than in reality, the fair value being higher than what's in the books. Now, let me therefore deduct 15 over here. And we get a difference, 5 million. And that's what we call goodwill. So the excess of the purchase price over the fair value of the net identifiable assets. Although that definition, which I just quoted, excess of the purchase price, it doesn't always work. It only works in a very sort of simplified world. Please recall from level 1 that goodwill is never amortized. It's not amortized. But as with all intangible assets, that it's an intangible asset, a very difficult one analytically to really explain and justify. But because it's got a useful life that is not defined, it's an indefinite useful life, it becomes mandatory to test goodwill for impairment at least annually. So it's tested for impairment at least once a year. You can do it more often. Typically nobody does. Right, not amortized, but tested for impairment at least once a year. And I want to show you the consequences of what we just did over here in the sort of using a financial statements template, because I want you to appreciate how things come together. So what I've got for question 1 is I've got on the assets, equity and liabilities, or in the relevant blocks, I've got the relevant numbers taken from the balance sheet of investor. So that's the acquiring company, right? And everything is nicely sort of summed up here. You can, I mean, trust me that these numbers have been correctly entered, like property, plant, and equipment 50, inventory 20, etc. You know, all of that is here. Because I want to show you now what happens when we consolidate, when we bring, following an acquisition, when we bring a new subsidiary into our sort of group financial statements. And what you need to do is basically account for everything that the new subsidiary is adding to the group. However, let's also note the fact that a payment is being made here. So a payment of 20 million in cash is being made to acquire the shares of that target, and obviously that 20 million leaves the group. It goes to the current owners or the previous owners of the target company. So 20 flows out of sort of group cash or the investor's cash, but in its place we get all those assets and liabilities that the subsidiary brings with it. The important thing is, following an acquisition, you're going to populate the balance sheet with fair values. Don't bother about book values. It's fair values that count. So when you account for the new subsidiary bringing its property, plant and equipment into the group, well, you're interested in that 16 million over here. Inventory, well, 5 million. Cash and receivables 2. So 5, 2. And then we also need to obviously show that the new subsidiary is bringing with it its long-term debt, its payables, 6 and 2 respectively. So 6, 2, brilliant. That's the way it goes. Now, if you were to try and balance this balance sheet right now, please note that I'm not doing anything to equity. When you bring a subsidiary into the consolidated balance sheet to show that it is now a member of the group, you don't consolidate its existing equity that was there at the date of acquisition. So over here, that 6 and 3 become irrelevant. The 9 becomes irrelevant from the point of view of consolidation. And please note that I've got nothing here because it is indeed irrelevant. The only thing that you consolidate on the date of the acquisition are these assets, these liabilities, and you leave it at that. So a net value of 15. And if we were to now check what the effect is, well, on the equity and liability side, those green arrows give a total upward move of 8. On the asset side, well, we had the outflow of 20 to buy the shares of the subsidiary, 20 down, but plus 16, so that's on a net basis 4 minus, plus 5, 1 plus, and another 2 upwards, so that's 3 positive. I mean, check absolutely on your own independently that the movements in yellow, but taking into account the direction of the arrow up or down, give growth of 3. I mean, at the end of the day, what you've got over here is 16 plus 5, that's 21, plus 2, that's 23. 23 minus 20 is still 3. And in order to balance the balance sheet, what we're missing is this goodwill, which sits on the asset side. It has to be 5, because that's the only way to get the two sides of the balance sheet post-acquisition to balance. So 8 here, and the only way to make that happen is goodwill of 5. And, you know, that's also what we computed over here beforehand. So goodwill is the balancing factor from a sort of balance sheet perspective in an acquisition. The answer to this question would have been A. Nice and simple. That's kind of what you were supposed to know at level 1, even though you were probably never asked to do the actual computations. Now, another still recap from level 1. So this is still recap from level 1. This question 2, but also question 1 was a recap from level 1. You should appreciate what happens when the purchase price is much lower. So this time around, I mean, the data is pretty much the same, but we're told investor acquired 100% of the share capital of target, but only paying 13 million in cash. And what is now the value of goodwill recognized in respect of the acquisition? So purchase price, right, drops to 13. I'm following the same logic as before. Have purchase price at the top, and now when I deduct, so minus the fair value of the net identifiable assets of the subsidiary, which are still the same 15 that we had before, and that's not going to change. I still, you know, when I evaluate these assets, I still think they're worth 15 on a combined basis when you add them up. So 13 minus 15 gives minus 2. And you should know that this minus 2 is not called goodwill. Under IFRS and US GAAP, we call this a gain on a bargain purchase, and it goes to P&L as something positive, as gains should. So the goodwill on this purchase would actually be equal to 0, because there is no goodwill, and we can't have negative goodwill. We used to have negative goodwill, but that was sort of more than 20 years ago. We now have what's known as a gain on a bargain purchase, so not goodwill, even though this computation reveals minus 2. It's not called negative goodwill. So let's explore this in a sort of via a template. What changes in question 2 is the purchase price. Only 13 million is paid for the subsidiary's shares. It's still 100% that we buy, but for a much lower price. It's a bargain price. You know, maybe the seller was pressed to sell and they accepted a much lower price. Good for us, the buyer. And we still consolidate all the assets, so we bring all the assets of the subsidiary in and its liabilities, but valued at a fair value again. So property, plant and equipment 16, inventory 5, cash 2. That's what we populate the consolidated balance sheet with. And on the other side, we've got the long-term debt. That was 6, and payables of 2. Okay, good. And of course, once again, I'm going to see if we can, if we can balance the balance sheet, and I know we won't, because now there should be a difference, but it will be a difference kind of assets being higher than liabilities or equity and liabilities as opposed to the previous situation. So 16 plus 5, that's 22, plus 2, all these items which I've shaded, or highlighted in yellow, give 23. 23 minus 13, the outflow of cash, gives net growth of 10. And obviously on the other side, I don't have 10, I only have 6 plus 2, which is 8. If I want to have 10, I do, to balance the balance sheet, I need to do something more. And as I told you, what we do is we take to our income statement, or P&L, the gain on that bargain purchase. That's where the plus 2 goes. And of course, as anything that goes to P&L, it ends up impacting our sort of equity, and that's the additional 2 that you need to get to plus 10 on this side. You've got 2, 6, and 2. That gives 10. That's the treatment of the gain on the bargain purchase. Now, for the really sort of level 2 specific stuff, because all of this was warm up. Question 3. Assuming investor now acquired less than 100%, 80% of the share capital of target in exchange for investors' no par common stock with a fair value of 16 million. So now, instead of paying in cash, investor is paying in their own shares that don't have a par value. This idea of not having par value just makes the accounting within equity a little bit easier. Not something you have to deal with, but it's a worry about really, but this is something that appears in a lot of the questions in the CFA Level 2 curriculum. Those shares have a fair value of 16 million, right? And we use those shares to pay for 80% of the other company's share capital. Now, we're also told that the fair market value of target was determined to be 20 million on the acquisition date. That is, I guess, repetition of what you had up here, and now it will become slightly more important, but not even in this question, in the next one. Calculate the values of goodwill and non-controlling interest at the acquisition date under the partial goodwill method. All right, so this is the thing I expect you to have to do and appreciate. The difference between computing partial goodwill and full goodwill, which will be dealt with in the next question. Please note that partial goodwill, and the examiners love these kinds of questions, is only allowed under IFRS. It's not allowed under US GAAP. Know that difference. Examiners love to test you on that kind of thing. And under this method, you pretty much follow the same logic as we did before. We had the purchase price, right? And we deducted the fair value of the identifiable net assets. But before, or in questions 1 and 2, because we were constantly, in both cases, talking about acquiring 100% of the share capital, I just said, let's minus a V of net identifiable net assets. I could have done it, but I didn't, for simplicity's sake. Said, well, let's deduct 100% of the fair value of the identifiable net assets. But I didn't, because I didn't want to confuse you. But now, this percentage is going to not be 100, it's going to be proportionate, so it will now become, whatever the question tells us, 80%. So we take the purchase price, or as we should probably call it, the fair value. Remember, we're not paying in cash in question 3. Instead of paying in cash, we're paying with our own shares, or investor is paying with their own shares. So we take the fair value of the so-called purchase consideration consideration is a synonym for, how much you give to the other side, and it's 16 million. So don't be surprised to see questions use that term, purchase consideration, instead of price. It's a more fancy and universal way of saying price paid. We still deduct from it, so we compare the price paid, but knowing now that we paid for just 80% of the shares, minus our share of the fair value of net identifiable assets. Because the snag is, or the crux of the matter is, why we're doing this, I want to see how the price that we pay, or the purchase consideration that we give to the other side, the payment, compares to what we get in return. And in return, we get 80% of a company whose net assets have been evaluated or determined to be worth 15 million at fair value. So I'm looking if there's any difference between the price paid and our share of the fair value of the net assets measured at fair value. 80% of 15 is, if you take 15 divided by 3, you get 5, you get 3. 3 multiplied by 4, it's 4/5 of 15. That's going to be 12 million, isn't it? So I'm deducting 12 million from 16, and I'm getting a difference of 4. And that's how you compute goodwill under the partial goodwill method. You check how the price you pay for a certain percentage of the shares compares to that same share of the company's net assets. And it's a very logical sort of consequence of all. It's the same approach that we had before, where we compared the purchase price when we were paying for the full company, 100% of the shares, and deducting the fair value of identifiable net assets, 100%. Here we just scale. We've got a price for a smaller percentage of the shares, and we compare that with the fair value of a smaller percentage of the net assets, so 4 million. Now let's go to a template, because it's really critical that you understand the consequences. So, one consequence, although that is not the sort of the critical one, is that we're not paying in cash, we're issuing shares, and these shares are estimated to be worth 16 million. So our capital, that's capital of the investor, increases by 16 million. There's not going to be a cash outflow. And now we need to consolidate the new subsidiary. And one mistake many people make is they assume that if you bought just 80% of another company's shares, that you should now consolidate or include in your consolidated group financial statements that subsidiary's assets and liabilities, but weighted by the 80% in this case, which is completely wrong. This is a way the examiner may catch you out. No, you consolidate fully. Why? Because even though you own 80% of that other company's shares, you're in control over the entire company. Control is a sort of 0-1 type of phenomenon. You can't control another business, or there isn't 80% control or 75% control or anything like that. Control is either there or it isn't. So when you control another business, even though you don't own 100% of its shares, you still consolidate all the assets and liabilities fully, because you're in control of the whole thing. So, just like before, I'm going to include that subsidiary's property, plant and equipment at a value of 16, because that's what it was identified to be at fair value, right? Not 80% of 16, the full thing. Same goes for inventory. Its value was supposed to be 5. I remember that cash and receivables was 2. Right, so we've got this absolutely same 100% same entries into assets that we had before when we were doing, when we're assuming that 100% of that company was bought. And over here, long-term debt, 6, payables 2, once again, following on with the same logic, we consolidate those liabilities fully 100%. So the 6 and the 2 enter our consolidated balance sheet. Now, we just computed that there was a bit of goodwill in this transaction, meaning the purchase price was higher than our proportionate share, 80% of the fair value of the net identifiable assets. And that difference came in at 4. Good. So I'm going to record goodwill within assets over here, because we computed it, right? So must record it. And let's see whether we still have some difference potentially that needs to be dealt with. Well, start with assets. 16 plus 5, that's 21, plus 2, that's 23, and 24. Well, that's growth or an increase of 27. And on the other side, I've got 16 plus 6, that's 22, plus 2, that's 24 so far. So there is a mismatch. I obviously want to make the right-hand side equal, the growth on the right-hand side equal to 27. How am I going to do that? Well, this is where the new item comes in, non-controlling interest. The question did ask for it, and you may be asked for it as well. Non-controlling interest. This is an item which sits within equity. And lots of people get confused why it's there. Well, for now, just trust me, it's here, because without that, the balance sheet wouldn't balance. But it's got a more sensible meaning as well. There's more sense to it. You see, what's happened over here is, okay, let me just unshade the goodwill. What's happened over here is I've populated the group balance sheet following this acquisition with the assets and liabilities of that subsidiary. Assets 16.5 to 23, liabilities 8. So I've brought in 23 minus 8 net assets of 15 of that subsidiary into my consolidated balance sheet, even though I'm not the 100, or even though the investor is not the 100% owner of that subsidiary, we still fully show all the assets that are under our control and liabilities that accompany those assets. And a consequence of this is that somewhere on the right-hand side of the balance sheet, you have to sort of admit that even though you show 100%, you're really not the 100% owner, and that's the item called non-controlling interest. So here, it's going to be equal to 20%, 1/5 of the fair value of all the identifiable net assets of that subsidiary. So 20% of 23 minus 8, 15, right? 20%, 1/5 of 15 equals 3. And you'll see in the subsequent video, in the follow-on video to this one, how this item, non-controlling interest, also changes over time when the subsidiary generates revenue, costs, profits, losses, because we also consolidate those fully, even though some of that profit or loss generated by the subsidiary is sort of attributable to shareholders who are not the investor. There are minority or non-controlling shareholders there as well. Okay, now let me show you the other way of computing goodwill, because you have to know this. And I mean, it is confusing, to be honest. Actually, before I do that, let me just write here, maybe just for the sake of clarity, because I did that in my note as well, that non-controlling interest Yeah, is in this case, it's the portion of the subsidiaries' net assets held, so of that portion of that 15, the net assets of the subsidiaries that were consolidated but held by third parties. Additional shareholders who are not in control, because we're in control, Target is in control, and Target consolidates fully but accounts for their existence via this line. So that's 20% of the 15, where 15 is the fair value of net assets. But in a moment you'll see that there is another way to compute goodwill. It's called full goodwill. This was partial goodwill. And when you follow the other method of computing goodwill, you'll get a different result from non-controlling interest. Now, from the point of view of the balance sheet and the classification of non-controlling interest, it's a separate component of equity. Okay. But, as I said, there are two measurements, two ways to measure non-controlling interest, and that's a consequence of how you measure goodwill. So one is this, and let me show you the next one, or let's discuss the next one via question number 4. Now, we're still going to assume that investor acquired 80% of the share capital of Target in exchange for investor's no par common stock with a fair value of 16 million. That doesn't change. The fair market value of Target was determined to be 20 million on the acquisition date. Finally, now, this piece of information will really be critical, and we are supposed to calculate the values of goodwill and non-controlling interest at the acquisition date under the full goodwill method. So, under the full goodwill method, you don't start off with how much you paid for 80% of the company. No, you start off with the fair value of the subsidiary, but 100%. What's the company worth fully? Now, even though we only paid for 80% of it and we paid 16 million, I have to think about what would it be worth as if I was to acquire 100% of the share capital. And we're told 20 million. In reality, you need to estimate this. What many companies do is they sort of extrapolate. If they paid 16 million for 80% or 4/5 of the company, what would they pay for the 5/5, the 100%? And by linear extrapolation, you would get to 20 million, right? Which is not necessarily the approach one needs to follow, because sometimes buying the whole company is, or paying for the full company is not just a scaling up of what you paid to buy less of it. Anyway, that's beyond the point here. It's not part of the discussion, but it is a discussion in accounting, how you should properly do this, not in the CFA exam. And once you've got this starting point, we deduct the fair value of net identifiable assets, but without doing any scaling, so 100%, again, as if you were buying the full business. And of course, let me say this probably for the last time, the fair value of the net identifiable assets over here was this 15 million. Those were the net assets of the target company. Okay. So I deduct 15 million. And I say, well, goodwill, full goodwill. So if that would be the price for the full business, and those are the full assets of the net identifiable assets of the company, goodwill would be 5 million, which is obviously bigger than the goodwill we had computed a moment ago when we did 4. Okay, so how does this change the accounting? Well, let's have a look. Question 4. We still issue fresh capital, fresh shares worth 16, so that's what goes up, and we still consolidate the assets of the subsidiary, so we bring them on to our consolidated balance sheet. The property, plant and equipment 16, inventory 5, cash and receivables 2. Over here I remember 6 and 2, right? So all of this stuff on the left hand side, 16 plus 5 plus 2, that's 23. 6 plus 2 is 8. So on a net basis, we consolidate, we bring in net assets at their fair values of 15. But now I'm saying that goodwill is not what we had before, because before in the previous question we had 4. Now I just computed that goodwill to be 5 under the full goodwill method. So here record 5. This is equal to 23. 23 plus 5, that gives us growth of 28, and we're supposed to have the same growth on the other side, right? Thus far we've got 16 plus 6, 22. 22 plus 4, 24, right? So we're missing an additional 4 instead of the previously missing 3. Well, obviously. And that's still called non-controlling interest, except this time around it's higher. It's 4. Now, how do you justify this in some other way than just whatever we need to balance the balance sheet? Well, let me explain that to you. This time around, non-controlling interest is not our share. It's that minority shareholders share 20%, not of the fair value of net identifiable assets, but times the fair value of the entire business. That subsidiary, right? Its assets were valued at 15, and previously we took 20% of 15. That's what we had over here, 20% of 15 to equal 3. But now I'm saying let's do 20% of the whole value of that subsidiary business, and that whole business, the fair market value of target was determined to be 20 million on the acquisition date. Okay, so times 20, that gives 4. It's just a different conceptual approach. So depending on how one calculates goodwill, they're also going to get different results for this thing called non-controlling interest that sits within equity. So let me consolidate all of that and summarize it and say that goodwill computation can be done using 2 approaches, the full approach and the partial. The partial is only allowed under IFRS. Important. The full is actually required under US GAAP and allowed under IFRS. So under IFRS you've got a choice. And one thing the examiner may want to test you on, but I don't really know why, that choice, which way of computing goodwill to follow, obviously they will give different results. The full method will show you more goodwill and more controlling interest than the partial method. The choice can be made not as a sort of accounting policy that you decide on and then keep to. No, the choice can be made on a transaction by transaction basis. So you can hop between the 2 methods, in between, from one transaction to another. But if we're doing IFRS reporting and we can choose partial goodwill, that will have an impact on our non-controlling interest and the amount we show, because on the acquisition date it will equal our proportionate I keep saying our, but I mean the investors' proportionate share of the subsidiaries' identifiable net assets. In our case, think of that 15, 20% of 15. Let me write that down. E.g., 20% of 15 to give a result of 3. Whereas if you are either forced to, because you're reporting under US GAAP, or you've decided to, if you're reporting under IFRS, to follow the full method, non-controlling interest will be equal to, once again, our proportionate share, but not of the subsidiaries' identifiable net assets, of the subsidiaries' entire fair value. In my example, it was 20% of 20, which gave 4, not 3. Right, higher goodwill, higher non-controlling interest, but the amount by which goodwill is higher also translates to the same adjustment or the same higher non-controlling interest.